My speech is about factor investing. The stock market has returned 11% per year on average since 1927. This means that if you're an average investor and you invest in the market, you can also increase the value of your investments by 11% every year on average, given a long enough period. However, we, the people, are always trying to beat the market. The reasons are plenty. It could be greed. It could be the idea that you can solve the puzzle that is so difficult to solve that not many people have achieved. It could be just ego. Or it could be even more charitable reasons. It doesn't matter. The point is that we are all trying to beat the market. But is it possible to beat the market? Is it possible to get a return higher than 11% without incurring in additional risk? Scammers will tell you that it's totally possible, that they'll give you 6 months and they'll increase your wealth in 100%. Remember the movie Wolf of Wall Street? Well, some smart fund managers have achieved great returns above the market for periods of 5 to 10 years. But guess where they are now? Most of them are retired in an island, and the fund is defunct because we tend to forget survivorship bias. Sometimes they take too much risk and then they end up failing because when the situation changed, you cannot manage it. I have tried to beat the market in 3 separate occasions that span about a year each one. The first time I tried to bet on macroeconomic variables, and I listened to the consensus of the economic analysts. Guess what? Those analysts were wrong and the signals didn't work. So I end up losing money. The second time I bet on trend following and trying to find the inflection point. See, as humans, we try to find the patterns. And if you see a cycle that comes very beautiful like this for the last 3 months, you think, I know how to predict that thing. You take action, you have some clever rules, and that's exactly the point where the pattern changes and is no longer predictable. So I lost money again. And the final time that I tried, I did it using algorithmic trading. I thought, well, maybe I'm not moving fast enough, so I'll get the computer to do it for me. And it was just accelerated losses. I just accelerated my previous experiment losses. Then I found factor investing. Factor investing is based on factors that researchers have discovered over the last 50 years that systematically can be invested on, and they have run statistical tests that give you a return positive in addition to the market. One such factors is the ratio of earnings to price, or earnings yield. The companies with higher earnings yield tend to have higher returns than the companies with lower earnings yield. And this anomaly has been documented and replicated time over time, and it's still going on as of today. And there are many explanations of why this happens. But it's not the only factor. There's also momentum factor. The winners of the last year tend to perform better in the next month than the losers of the previous year. Another factor is the ratio, the fundamental ratio book to price. Another factor, earnings quality. If you look at how the company is getting their earnings, how ahead they are in their payables and the receivables, you can also find a signal. But the key is to build portfolios that are large in the amount of securities that they have, because the statistics are going to be on your side when you use a large universe, not when you try to predict one thing over time. Time prediction of returns is much harder than you would think in the beginning. So it turns out that people have been using these principles for many years. I learned it from a professor at UC Berkeley who was a director at BlackRock, was the director of scientific investing. And he had been applying these factors for many years successfully. Also, in the Chicago School of Business, Professor Eugene Fama had a lot of disciples who went up and created funds that leveraged these factors. And they've been working very well for many years, creating funds over hundreds of billions of dollars in assets under management. Now we even use these factors for risk management in the most successful hedge funds in the world. There's a lot to learn about factors, but today I just want to encourage you to learn more about it. You can, for instance, read more in AQR's website, in Morningside's website, or in the book Advanced Portfolio Management by Giuseppe Pagliolo. Or wait for my next book, hopefully by the end of this year. Thank you.